Hey everybody, Preston Bryn here with our weekly roundup brought to you by Trader User Group. Man, we've got a really interesting past week that just occurred. Um, as I said, through the end of the week, May 19th, we actually had a down week, but we finished very strongly over the past 2 days, and I wanted to show you that in just a second. But last Wednesday, just to put it in perspective, we had about a 1.8% sell-off in the S&P 500. And that was just the second day this year um, that we've had a sell-off greater than 1%. It's really rare that we've gotten a 1% or greater decline in the indexes. And to make it even more impressive, the Nasdaq, we've gone over 171 sessions without a downdraft of more than, excuse me, 2%. That goes back to 2006. I mean, it's really amazing um, to see a downdraft of more than 2% in the Nasdaq. So we've got a very strong desire for buyers to keep this market propped up. And so what everybody wants to know is, is the Trump bump going to turn into the Trump slump? Or are we going to kind of stay in this consolidated range? I'm going to show you what the charts are saying, regardless of what the TV talking heads, the crazies on TV, or some of the analysts are saying, because you've got to follow the price action. Whether it's logical or not, it tells you what the markets want to do both short term and going out in time. And not 100%, but it gives you an edge of over 55 to 60%, and that's the edge that we're looking for in our group. And thus far this year, we're having a great year running against the various indexes. So let's take a look at what the charts are saying. What I've got on the screen here is the S&P E-mini 500 futures, and that's the primary go-to index that we use for the U.S. markets. Now, I've got a lot of activity on the screen. You can see a lot of yellow dashed lines, green lines. You can see some colored bars on the screen, a big blue thick dash line. This chart has not changed the entire year. For those of you that are watching my updates every weekend, and we got a lot of people that do, you know that we've been fairly accurate in where we're calling everything. So what do I see now based on the unexpected move lower this Wednesday? Well, if you look at the charts, the first thing that jumps out, and I'm using eSignal, by the way, which is a great charting package. You can see right here, this is where buyers versus sellers are really having a big battle. And you can see the last really big battle is right down in that area there. Again, buyers versus sellers. And obviously, the buyers won right here. Right here, it's a question mark as to who's going to drive it higher. And you can see the peak point of each of these are on or near key levels. Down in that area there, it is a key Fibonacci extension of prior pivot highs and pivot lows. And I did those extensions off a weekly chart because, again, this is a daily chart, and I'm looking at just trying to ascertain, what are the odds and where's the market seem to be reporting for the next 30 to, let's say, 45 days out. And a daily chart is really good for that. Weeklies give you about a quarter at a time, 3 months, 90 days, 120 days out. So if we look at this, we can see that we had this all-time high. We made a new all-time high this week and also fell a huge amount during the same week right down to that downsloping trend line. And as you know, a trend line is defined not by the first point of touch, but been by the second and the third, and then you can see the fourth when we came down and it held right there on that gap up when Macron won, or it looks like he was going to win the French election. And then we just gapped up, and we've never looked back since until Wednesday when we came down and that downsloping line held up. As you know, you need at least 2 touches to define, I think, a really good trend line. And that does not count the very first start of it. So I want to see 2 touches. And we've gotten 2, we've gotten 3, we've gotten 4. So clearly this trend line, this downsloping trend line, right, is a valid line that we use. So we go check, let's leave it on the chart. Now, that logic has been on every line that I've got on the screen and every bar and everything else. The other thing that I always do is I put in the all-time highs or the highs for the year. In this case, it's all-time highs. I also put in the open price, and you don't see it on the screen, but the low price for the year, because these are what I call headline numbers. You know, the highs for the year, you'll usually see the Rat Brain Business Journal of the day, the National Enquirer, come out and say markets at all-time highs, or markets go back into the red again if we move through the open price for the year, or markets make all-time or new lows for the year. Those are headline numbers, so I only have them on there, and you will see many times prices tend to revert back to those areas when we get near them. It's just like a bug zapper, and price being the bug, it can't help but touch that that key level. So let's take all of this off the screen here, and let's come back to Wednesday's move. You can see on Tuesday we made all-time highs, right? And we actually closed down on the day, but just barely. But that was kind of a given there. Once we removed, and I've been saying since this point in time here, we're buy on the dip, right? Meaning as the price came down, that's the dip. We were hitting that. And then we had this this symmetrical triangle playing out here. If you recall what I was saying at this point in time, I said I favor a break to the downside, even though statistically a symmetrical triangle has a break to the upside, because that was the direction with which we entered that triangle. So statistically it favors a break to the upside. I said we would break to the downside, which we did, but we didn't really take out that key pivot low at 23.17. Was met by buying going into the French election. We gapped up above, and then I said, okay, the odds now favor probably coming out and taking out the all-time highs, which was at that time back over here. And that's what we did. And then we just made a high, a higher high, and a higher high there. Okay. Now, Wednesday's move caught some people by surprise, but that's okay. I knew that even after that Wednesday move, we were still in a buy on the dip kind of environment, all right? And if now, when I say I knew, I didn't know with 100% accuracy. All you know is you have an edge, and my edge was about 58 to 63%. Based on the statistics of how these patterns play themselves out. So that was the edge that I had in watching this thing. But let's zoom in a little bit closer, and I'm going to tell you where my focus is going to be this week. Because understand, I don't care how good your stock is and how favored it is. When you have a big, huge downdraft, the odds favor that stock to go down. Now, we had almost 9-to-1 ratio on this day right here. When we had on Wednesday, when we had that 1.8% move to the downside. And by the way, it started in overnight hours and it kept right on going. The minute markets opened back Tuesday night, the future started selling off, and I think we were down about 8 to 10 points before I even turned in for the night. And then when I woke up in the morning, it just continued on, and the markets opened and it just continued. So there was clearly some profit taking going on. But now, what am I going to really pay attention to in this market, and what I want to watch? Well, let me just clean the screen up here for you, and then I'm gonna make it easy for you guys, so I get all of this off the screen. So there's just a couple of things I'm going to watch. That was the high point before the downdraft. That was the low point. And then you can also see we made that low point right there because we went down a little bit because the momentum, right? Once we opened up on the second day there, the momentum, we opened there, it took us down about another 10 handles, and then we quickly moved and we closed right back here, and then we opened here, and then we've moved right back up here. So the key points that I'm really going to be focusing on this week is really very simple. And sometimes simplicity works very well in this market. So what I'm going to do is I'm going to say there's just really two levels I'm going to watch. Level number one is 23.4450. Level number two is 23.96.75. You'll notice that was the prior, and again, this is short term. I'm using the daily chart, but I'm talking shorter term. I'm looking at the high point that we made Tuesday night or Tuesday before the Wednesday morning downdraft, and then the low point on Thursday before we reversed ourselves and closed back up. Okay, so that's what I'm looking at. Now I'm going to take this, and I'm also going to, just so you know, that's a range here from this point right here to that point right there. You're looking at 23.96 from 23.44. So you're looking at about what is that mathematically? About a 52 point range roughly from here to here. All right, so about 52 points. So and we're right up here in the upper third of that range. If we clear this area here, then it's kind of like, okay, it takes away, almost negates this move down here, and it says we're going to go back into that consolidation mode again. All right, and you can see here when I went back to the beginning of April, there is now two major zones here for buying versus selling, right? And there's two of them, and not surprisingly, they're at the top and at the bottom of this range. So that's why I'm focusing on this area here. The other thing that I'm going to add to this is I'm going to come in here and I'm just going to do a Fibonacci, right? So I'm going to come in here. Let me just get it set up the right way here. Let's see here. Let me just come back and let's go Fibonacci retracement like that. Well, I got to get it going the right way, don't I? Let me just see here. All right, let's get the defaults back in here. Well, it's not working for me. I got to play with it because I've been in here messing around with it. Let's go like this. There we go, like that. Perfect. Now, you can see right here from this pivot high here, we came down defining this part here. I'm looking at this area right here where it's going to be kind of a zone of congestion right in that area there. The 38 to 61%. Now we're up here towards the the top boundary of this area. So I would not be surprised to see us kind of mosey down here again. But if we come back and take that out, then buyers are clearly back in control and pushing it back up. But again, these are the two areas that I'm going to watch very, very closely. Now, one other thing I wanted to point out to you guys, let me just clear this off the screen here for a second, okay? And then I'm going to step back out a little bit, put a little bit of macro perspective on it. So let's just step back out. And I want you, and I'm going to go back a little bit further in time, right? Now, let's take a look at the volume. Look at this, guys. You can see right here, and let me just raise it up just a little bit just to kind of really show you where we were here. And let's just go like that, just a little bit like that. All right, so now look at these 2 days right there. That's what I'm focusing on, just the 2 up days. Look at the volume, guys. I mean, you know, the first day was here, the second day was here. Both of them, right? If I extend the peak of the first day, and then extend the peak of the second day. There's the first day, and there's the second day, like that in volume, right? And that's going back right around the Trump bump. There was only one time and one day that we had that there, and that was right there as we started to move back up again, right? I mean, that was kind of a definition right there of, you know, the 50 EMA, and then boom, we took off again. But now we had not one but 2 of them. So there was a lot of volume in buyers, which said, you know, again, here's the buyers versus sellers. Buyers won that round, and they took us off this extension of the 2341 fib node. We came almost right down to it. We regained, and boom, we moved back up again. So one of the things that I do in my volume, and it's no different than a chart. Now in the volume, I use 5/20 moving average of the volume. I don't do that on my chart. On my chart, I'm generally running 4/12. And I know a lot of people do a different number of combinations. There's probably as many different combinations as there are traders. These work very well for me based on the settings I have on my other charts or other technical indicators. But you can see here, we actually started picking up lower volume right here when the 5 went below the 20. And we did not regain it until right here on Thursday, and we started moving up. So this move from here to here was all on declining volume. And that got me a little bit nervous. And then when we took out the prior pivot high there and made an all-time high here on relatively low volume down here, lower volume than we made over here, right? If I draw a line, you can see one is clearly higher than the other. And we're getting as a percentage of stocks, what I didn't mention was that we've got, of the S&P 500, stocks that are above their 50-day moving average are only right about 50%. You know, so we've had, and that's from the highs of about 80% of the stocks in the S&P 500 over their 50 EMA. So that just means less breadth in the markets. So you put all of this stuff together, all of it, and it spelled, you know, let's just work off some of this here. Let's just work some off. Now, the good news is that earnings are doing very well. Okay, we're just about wrapping up our Q1 earnings, and we came in at a profit gain of about 15%. Okay, it's a little bit of a Goldilocks scenario because earnings are very strong in Q1. In fact, there's projections now for the next quarterly GDP number to come in very strong. And the yield curve, or the 10-year Treasury notes, hovering around 225 basis points. That's 2.25%. So you got low interest, strong earnings, right? And Trump talking about doing stimulus if he can get it through. That, my friends, is what's keeping the markets up in this area here, right? And if we look at it, that is where we're sitting. And from my perspective, if I put everything, if we just step out even more, right? And let's just condense this so you can see the Trump bump from the elections right there. You can see right here, all we're doing is we're hanging out in that area there. The odds favor a break to the upside. And it's just a long consolidation package that we've been in, or an environment we've been in since the middle of February, right? And then March kicked off, and then we just started that down sloping run in March, just like that, right? And then if I were to connect the dots here and just show you that was what I was looking at. And then, of course, we broke where I said we would break, but we didn't really come down. We touched it, and then off we went to the races like that. And all we're doing, even with that big downdraft of 1.8% in the scheme of things, it was nothing, absolutely nothing in my mind. If we have 2 or 3 weeks of multiple 1.5 to 2.5% downdrafts, then I'll change my tune, supported by increasing volume. We're not seeing that. I'm not seeing that. So this is kind of where I still believe the markets are going to stay until there is some stimulus, either stronger corporate profit, or not profit earnings, but some signs of the living in the U.S. Congress and the Senate. They can get some of these stimulus packages through, or we get maybe more hawkish news out of the Fed. Remember, the Feds are going to be meeting here in June 13 and June 14. We get the Feds meet. And on the quarterly end, there's about over an 80% chance. It used to be 97%. I think with Wednesday's downdraft, it reduced it a little bit. But still, everybody expects 2 rate hikes for the year, one in June and then one in Q4 of this year. And they expect Yellen to come out. We call her AKA Aunt B. And she's still been very dovish. People expect her to stay dovish. So let's see how this thing shakes itself out. But this is just kind of where I believe the markets are right now. So watch those key levels. If we take out that high key level that I said earlier, we're going to, you know, the all clear sign is going to be given. We're still hedged to the downside. but we did move for just a day or two in a backwardation environment with the volatility futures on VIX in the front month, but then we're back now in a normalized environment or a contango environment on the term structure. So I think we can stay a little bit choppy, but we're going to probably be here. I don't see us getting back up in this area here. If we get something out of Congress and then we see movement in the Senate, primarily in the tax package, we're going to come up to that next fib level at 24.68. Okay, we don't, and then you can clearly see, I've pointed out, and they almost align really rather nicely with our fib levels, right? I mean, you can just see here, and what I'm pointing out here is the major volume over price of buyers versus sellers, right? And it's amazing that that also happens to coincide with the fib locations. And I don't make it up, but that's why Fibonacci is so good if you know how to pick the right pivot points. If you can't pick the right pivot points, then you're not going to get it. But you can see here that these are the major areas of support underneath the market if the market start coming down, right? And you can see the 200 EMAs right in the middle of the second one. So these are the levels that I'm looking for. Otherwise, it's kind of same-o, same-o. You'll see volatility pull back. But again, go into the short time frame, watch those key levels. If we take out that lower key level, then we're going to come down to 2,300, I believe, fairly quickly. And then we'll probably break that and come down and test the 2263 area. That's assuming that breaks. If it doesn't break, then we're going to stay in this kind of grinding mode a little bit longer than people think, or at least until we get some other stimuli from the government or from some headline number that's going to move the markets. Okay, and you can also see the VIX closed Friday at 1204. We were in the yellow zone 2, and then we moved back down into zone 1, which I call zone 1 here. When we moved up to zone 2, we were starting to get ready for some more hedging. And generally, when you move into a zone 2, you start to move into a backwardation environment. I mean, yeah, in a backwardation in the term structure, and then you just take it on up from there. We hit lows that we haven't seen in over a decade. We were down at 956 in volatility, and we were picking up long vol down in this area here. I mean, it's just a prescription to pick up long vol. And then you can see the massive withdrawal with all that volume going back into equities. You could see that move there. And what was also interesting during this 3-day craziness that we had, look at the bond market. The bond market, you would never know we had that big up move on Thursday and Friday. The bond market is still forming this pattern where if I were to draw it down, it could be one of these kind of things like that, like with either a cup and saucer pattern or just a double toppy test. I'm not really sure which. But if it gets up in this area here and we break, the odds, the pattern calls for about anywhere from an 8 to a 10% run once it takes out, the prior peak. That's not to say it's going to happen here, but it could. If it fails and I get a sell signal, I would be very happy camper to sell bonds up in this level because it's going to come right back down here again. And you can see the bond market touched the open price of 2017 perfectly before we got that move higher. Okay, so the bond market never really sold off with the big move up on Thursday and Friday. So the bond market is there is still risk in the marketplace. The bond market is telling us that. The bond market is telling us that money still does not want to assume too much risk. I think that drawdown on Wednesday kind of scared a lot of big money, and they just kind of went into bonds and they're sitting there for a while, and they want to see over the next week or two, are we going to come right back down again? Or is it going to just wear off and then just kind of grind higher, which case we'll see the bonds roll over. So bonds is another thing that I'm going to be watching very closely. Meanwhile, the poor U.S. dollar, which and I've been telling you guys now for several months, it's just going lower and lower and lower. And if you look at the pattern here, we're making lower lows on the dollar. And I know I've been saying almost the entire year, right? We're just going lower and lower and lower. And I have not seen any signal that says any rally should be bought. Every rally thus far is an opportunity to pick up shorts in the US dollar or longs in the euro. Now I'm playing the long side of the euro because I like it. But I just don't see the dollar clearing this down-sloping trend line at this point in time. And then the logical trader would say, wait a minute, interest rates are going higher. The Fed wants to take money out of the market. They're going to even talk possibly this June about reducing the balance sheet of 4.5 trillion. Wouldn't that make the dollar go higher? Well, yeah, logically it would. And it may in fact move the dollar up to this point here, and then I will be looking at a possible short again, because as I said many times, the dollar is really not the dollar. This is the dollar index. And this dollar index really is controlled not by the dollar. It's controlled by where the euro goes, where the British pound goes, where the yen goes, where the Swiss franc goes, where the Canadian loonie goes, or the Canadian dollar. Those currencies and the euro makes up the biggest percentage of the US dollar, over 56, 58%, somewhere in that area there. So generally the euro and the dollar go in opposite directions. And I've been moving our members slowly into some more things in Europe. And I like the euro. I like those things over there, at least through the end of the year. I still am holding, by the way, to my, and I've said this, I've been saying it now for about 8 months. But I believe, and even 8 months ago, I said about a year to a year and a half. So that would make me less than a year, I guess, for my timeline. But I would say within the next year or so, I'm expecting a 25 to 40% pullback. I think near term we can move higher, but I do believe we've got some downside, big downside risk out there that could just really upset all of these markets and set the entire market in a tizzy. And just watching what happened on Wednesday, everybody's got nice profits, since, if we come back out and we look at from 2009, right? And this is a weekly chart, but if we come back to 2009, right? And let's come back over to the E-minis here where you can see, I mean, folks, this is where we've been since 2009 from right here. And what I'm calling for is essentially, and by the way, that was the 2007 high. In fact, let me do it this way, because this is what I'm calling for over the next, probably the next 12 months or so. It may string it out to 2 years. I mean, who knows? But I do believe we're going to come back and test that. Right in that area there, 2007 high, dot-com bubble high, right around 1600. That's where I think we're going to go, okay? That's what I think is going to happen. And that is going to require a nice hefty little pullback here from a Fibonacci standpoint, but really not that great, right? I mean, if I look at this and let me just give you one other view here. If I come in here and let me just see if I've got this thing set correctly. No, let's do it the other way. Like this here. Yeah, here we go. Like that. You can see right in this area here, right, and I'll just do that peak right there. So you can see a 50% pullback right there is 1540. And that would be a fine pullback on the fib node, 50% pullback, right? And I could see us coming down to that level there, just like that. Remember, we had over a 47% pullback there, and a little bit a similar pullback from that standpoint here in the dot-com bubble. That's over 45 to 47%. Okay, this pullback right here is nowhere near that. I think if we were to look at the pullback there, and if I were to do it as a percentage, just to approximate this thing here, it would probably be around, let's say, what is that? 35% roughly, right? 35% pullback. So that just shows you the power of just clearing the house, clearing the deck. And that's what I would expect, 35%. And that was nowhere near what we had during the the '07 crisis. I mean, if we look at this, and I just go from the peak high here to the peak low there, right about there, you can see in that case right there, 58% pullback from the peak in '07 down to March 9, 2009, right? Or March 6, 2009. That's kind of where we hit the lows right down in that area there, 58%. So folks, this just shows you if you put things in perspective, these little moves here don't even show up on the weekly chart, right? Let's just zoom back in. And I need to put this in perspective so you guys really understand just how ugly it can get. You can see this pullback here hit my fib node of 1.1 or 61% extension off the prior pivot high and pivot low. But you can see here, it barely shows up. It just is one bar because it's 1 week. That would be that bar right there. And pulling back even to that node right there, which is 2302, so I'm going to call it 2300. It's just the zone. That's what I was personally expecting right in that area there. And we haven't finished this yet because on a weekly bar, this closed down, not up. So we could have a little bit of a bull flag or a bull trap, get people in, and then boom, we come back down here again. So we're not out of the woods yet. I mean, the good news is that we had a lot of volume support Thursday and Friday. But the bad news is over the next 2 or 3 weeks, we're going to see real quickly if it's going to turn out to be just a bull trap, and then we're going to be down, you know, to the level that I'm looking at, 2,300 down to about 2,263. All right, so that's what I'm watching for, and that's how I'm going to approach it in the chat room with our members as we kick off Tuesday, or Monday rather, for this week. So that's a little bit about that volatility in the bonds and the currency market. Now, if we come down and look at gold, you know, this is where I diverge from a lot of people. Some people are saying gold is going to be more bullish. I'm saying I'm not entirely convinced yet. I want to see us come up and take out some of these higher levels around 1270, 1280, and then I'll be more convinced. Right now, I am still showing on this chart a little bit in this little pattern here, a move up and then a down, and let's get a capitulation moment down in this area here, because I was expecting gold to come down to around the 1200 zone, perhaps just a little bit lower. So if we can't get up above this area here, then that's where we're going. This here would suggest the markets are going to grind a little bit higher. So let's just watch this and see, but that's kind of what gold and silver was showing me, although silver is a little bit weaker than gold. I mean, you can see this huge downdraft in silver here. It's trying to make its way higher, but to me, it just looks like it's going to roll back over. If we can take out some of these key points and move above 17 and stay up there with some convincing volume, then I'll be a little bit more prone to do that. And if we look at oil, well, the big week this week is Thursday. Thursday, May 25th. That's when OPEC meets. And you know, I guarantee you they're going to come out with positive stuff. They're cutting production, they're doing this, they're doing that. And meanwhile, we're also getting reports here out of the energy agency that the frackers are pumping more, doing more. So the frackers are replacing what Saudi's taking off the market and OPEC. So it's going to limit the up move, but I think we're going to get some, because every time OPEC meets and they come out with stuff, then that's what happens. Okay, so, but we're still playing oil. I don't think oil is going to get much more than, you know, even through the rest of this year, the mid to upper 50s. I think it'll be a stretch to get anywhere near 60. I just don't see it happening. So I think we're going to continue to be range bound in oil. So folks, and we've got some other things I'm looking at in the ags and in the meats, but this is where we're sitting with the markets right now. Really interesting week. Let's make sure when the week, this next week comes up, again, watch the highs that we made. Let me get watch the highs going into the Wednesday downdraft right there, and then watch the lows that were made on Thursday before we, you know, finish strong up to the upside. Watch those very closely. Whichever one we take out first is going to be where the market's going to want to lean. And that's what we're going to be doing here. So I get everything back on the screen again. This is where we're sitting. Members, I will see you Sunday night. We got a really cool session coming up. For those of you that are not members, I highly encourage you to come in. We're doing a lot of really interesting things. I'm teaching a lot of our members also that have portfolio margin how to use the Thinkorswim platform the way it was intended for portfolio margin, and then what option strategies leverage portfolio margin better than others. And you don't see that in 2 minutes. There are a few people, just a handful, that show you that, but not many. And you're not going to get it in the book. So for those of you that are interested, come on in and join our group. Otherwise, members, I will see you tomorrow. Tomorrow night when we'll talk about our secret trader and the trades we got for the year, and the new one we just put on Friday using that what we call the super bird, I think you guys will enjoy it. So I will see you guys then. Otherwise, have a great weekend. Take care, everybody. See ya. Ciao.